Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Meg Epstein, based in Nashville, Tennessee. She's a real estate developer with over a decade of experience and has been involved in development and construction of over 1 million square feet of residential and commercial real estate, representing over $780 million to date. So thank you so much for being on the show, Meg.
Yes, thank you for having me.
So give us a little background of yourself, both personally and professionally, prior to getting involved in real estate investing and development.
I've pretty much been in real estate since I graduated from college. I wanted to be a developer, but I graduated in 2008, and so it wasn't the best career path to take. So I got a job in construction, actually. So I was on job sites for the first couple of years of my career and really learned construction and project management that way and building. So it was definitely very different from what I do now, but obviously related.
Nice. Okay. And so why, when you chose, I guess you moved from California, why did you pick Nashville as, it's a growing city within Tennessee, which is a growing state. Why did you choose that as the place for you to move to start your construction business there?
It was actually more of a spontaneous thing. My husband, when I met him, he was from San Francisco and he had moved to Nashville just kind of on a whim because he came for a weekend and he liked it so much. So yeah, that was basically, I met him and I came and visited one time and then just moved here. So it was kind of very fast, but I liked the city when I came. It was like 2013 and 14, like very different city, but I still could, I knew I would like it here. Nice.
Awesome. So your firm, CA Self-Development, what types of construction projects does your company currently focus on at this time?
We are primarily focused on mixed-use urban infill projects, so apartments with retail below, more in denser areas of Nashville. And then we also do industrial, and our industrial projects are meant for more middle market tenants, not like big box, like Amazon type tenants, more middle market tenants. And we basically chose those asset classes based on the data that we saw in Nashville and the Southeast in terms of what was being really undersupplied.
Yeah, residential and industrial are pretty much hot everywhere. I'm being in Florida in the whole Southeast. It's something that is lacking, especially industrial. And when you're doing these industrial projects and you're doing any type of improvements to them for tenants, like what type of businesses are going into them? You said not big box, like industrial, like companies that might need it, not big box stores.
Yeah, it's actually given us an upper hand it's so competitive to find land now. It's obviously really strong seller's market, but when we go to work with a lot of sellers in Nashville, they're, construction related businesses or just kind of even industrial businesses, but they're sitting on land that's worth so much. And having the industrial platform has been able to allow us to help them in the process of finding them new locations. And so we that was kind of how the idea came about. We saw that trend of strong rent payers, but just, they need 20,000 square feet, like an HVAC company, for example, or a lot of construction related businesses, or even just retail e-commerce. Like as retail goes away, people need smaller, they're not some big, they don't need, 500,000 square feet. They need 50,000 or 20,000 square feet. So those are kind of those middle market businesses we target with that product.
Oh, that's great. That's awesome. So for different funds that you're running now, which I found very interesting because you have a qualified opportunity fund, and can you tell us more about what you're targeting with that?
Our opportunity zone fund. So we've set up, I guess, almost 5 single asset op zone funds now. So we've been pretty much on the forefront of that since the legislation came out in 2018. And like I said, I think we have 5 or 6 op zone projects. So we kind of understood the nuances of that, and we have a great legal team that deals with that. But we basically just target opportunity zones projects, and it's all ground up. Not all of it. Actually, our new headquarters is in an opportunity zone, and you have to, as part of the legislation, you have to double your basis. But it's basically just these geographic areas that are designated as opportunity zones that give the investors the tax advantages of holding for a long term. So usually those projects are in urban locations where the city wants, development and building to be sparked. So in some cases, they're not really in so the idea originally was for it to be in neighborhoods that really need a lot of gentrification or, more investment. But in Nashville, they're placed pretty competitively in really prime neighborhoods. So it just depends, we kind of tailor the product type depending on the neighborhood.
Yeah, it's very interesting that you said that, because I was doing some research on just talking to some other qualified opportunity fund developers, and there's like over 8,000 of these qualified opportunity fund zones in the United States. And they finding that a lot, that they're finding these zones that are not where you'd think they are, but where they've been zoned, and it's actually right where where there's a wave of gentrification. So you're finding that as well in Nashville?
Yeah, and different cities are really, varies wildly. I mean, Nashville is very close to the urban core. I think Chattanooga is another market we were looking at, which is obviously pretty close to Nashville, but I think their entire downtown is in an opportunity zone. And then you have other markets like LA and Austin where it's, way far out of the urban core, and you're not going to get them unless you go hours outside of downtown. So I think it just depends on, I'm assuming it was highly political when they made those tracks, but.
Yeah. Interesting. So as over this last 10 years plus that you've been doing real estate development, real estate is a very capital intensive business. How'd you start off raising capital for your deals, and now you've grown into raising capital for funds for these developments?
Yeah, I first started, I took the CCIM courses, which are like a broker designation course, which is kind of like a mini, almost master's in real estate or something. And it was very beneficial for me because it's a very practical application of investment underwriting for real estate. And I found that that was, my first foray into actual investment. And a lot of people have a lot more. I have people on the team that are so sophisticated in terms of how they underwrite and Excel and, investment banking backgrounds and things like that. But I didn't have that. So I took those courses, and I got my first deal together. I just really went online and Googled where to get real estate capital. And, I just did a lot of cold calling, just kind of to whoever I could talk to about how to invest in real estate. And I knew I didn't want to syndicate, one, because I just didn't know a lot of people that had money. Typically when people start out, they get their first apartment deal, and then they go to friends and family and hobble together a couple $1 million. And I just didn't know people that had a lot of money, and I didn't want to do that. And so I looked for more of one, private equity fund that would invest. Now, I didn't have a track record or anything, but the first one I found was off of the CCIM directory. I think I did a posting of the deal, and I was like, this is in Nashville, and this is like in 2016. And so Nashville was gaining popularity, but it wasn't like what it is now in terms of like the darling investment market. So he flew down to Nashville. I mean, it took me, I called him, a lot of times, but he never said no. So I just kept following up. And then he came down to Nashville, looked at the deal. It was like, okay, I'll do this deal. And he structured it in a way, it was really lucky for me because he took a chance on me. I mean, I called hundreds of people though, so I don't know, you can call that luck or you can call it, just odds. But he came down and he structured the deal in a way to where it would be extremely hard for him to lose money because I didn't have any money to put in the deal. And so he provided all the capital, I provided the deal, we worked together. And anyways, it ended up being extremely successful for both of us. So he invested in more deals, and then I attracted, as we grew and our deal sizes grew to being, typically over 50 million or so a deal, then we started, working with more institutional investors, and that's who we work with exclusively now.
Yeah, I imagine that's much easier to put those deals together with just having a handful of investors compared to having a number of different limited partners that you're raising funds through.
Yeah, and I think we touched on this earlier, just in terms of it is easier to do larger projects. And I think a lot of people spend a good portion of the beginning of their career syndicating and yeah, it's just I've never seen that to be, I don't find that very scalable. So I've avoided that.
When you're saying larger projects are easier, is it saying not just raising capital, but is it also with managing the whole project, finding places to put, like everything goes together? I would imagine it's much easier to find your contractors and vendors because they want bigger deals. We find that in multifamily all the time. I'm going for somebody to price out some sort of work for a property. When you tell me you have 100 units, it's a much different story than if you're looking for 5 or 10 units. And are you finding that throughout the whole project, it's just much easier to do these larger projects?
Yeah, I mean, there's, just to be fair, and like a precursor, there's nothing easy about ground up development at all, right? I mean, I started and I built a ground up condo building and a ground up office condo building, which are like with no track record. I mean, that I wouldn't recommend that to anyone because it is extremely difficult to do ground up development, let alone in an asset class like condo that isn't, it's not like building a multifamily building. It's a lot less financeable. And so it was extremely difficult getting through all of the heartache of learning, the ins and outs of development. But now that I'm there, I would say, yes, it's easier. I mean, it's definitely more competitive as you get into the larger deals because you have a lot more institutional shops with a lot of capital behind them looking at them. And especially in more markets that I spend time in and built relationships like Nashville, if you have the deal, if you can find the deal, then yes, doing larger deals, you get one equity check from an investor, you get a lot more. I mean, in this market, trying to find general contractors that can execute and show up to your job sites is a whole challenge in itself. And so when if you're building, they have an $80 million contract there, definitely you're going to get some very professional groups. And it just kind of goes that way throughout the entire deal stack in terms of, architecture and financing and everything. So, yeah.
So over 10 years plus of doing all these types of developments, how important have you found it to do proper due diligence on people that you're working with or partnering with on deals?
Oh, yeah. I mean, it's extremely important. We do, on the team, we have a pretty extensive, on my team, we have a pretty extensive background check process and just interview process, and not just for ourselves, but also for the people that join the team, because we want to make sure that it's the right fit for them as well. And it is very, we're very hard charging, and a lot of people on the team, I mean, everyone's extremely smart and talented, and to work in that environment it takes a certain type of person that has similar goals. Some people don't want to, you know, be horribly aggressive and grow very quickly and build massive buildings. And that's fine. It's just, that's what it takes to work here, right? So, so we go through a pretty extensive process for that. And, you know, I have people interviewed by my board members, and we come meet the team, and testing and background checks and a whole extensive thing, just because I think it's, we are small. I mean, we've grown very quickly, but we're still relatively small. And so working so closely, people have to be, you know, comfortable with each other. And then on the partner side, yeah, I mean, mainly we're taking capital from institutional partners. So there's not like a lot of background checks to do, but you always spend time with your investors and go to dinner and kind of get to know, unless it was during the pandemic. I never met any of them, and we did some deals just over Zoom. But beyond that, it's like, there's a lot of places to get capital from. And at the end of the day, like, I don't want to be working with someone that's not aligned with, one, like, I care a lot about the architecture of the projects, and I care a lot about how the end product ends up and how people live in it. And I'm not just building a stamp and repeat, you know, 300 unit apartment building that looks like everything else. And so one of my investors is a public REIT. And one of the reasons I started working with them is because a lot of REITs just tend to be really utilitarian in the design. And it's just like, it's just about like almost a commoditized product. And this one I'm working with really cares about that dialogue of creating healthy spaces and kind of shaping the urban landscape in a way that's different, and really spending time on the floor plans so that they supply what's undersupplied in that market. Like in Nashville, there's an undersupply of 3 bedrooms, for example. And so we really look at those things. We look at, oh, how has the pandemic shaped how people live and work from home? Do they need, you know, we need to have areas or rooms where people can have separate Zoom calls if the husband and wife are working at, you know, in the same apartment, things like that. So they spend a lot more time. So you can get money, I can get money from a lot of places now, but I want to work with people that are positive. And, you know, I've had my share of experiences from like, just, you know, people from like more like a New York attitude, like kind of a-holes, and I just don't need it, right? So I want to have people, you know, we create more partnerships, and that goes down with any type of work that your listeners are doing, or any people that are partnering. It's like in any sort of venture, even if you're flipping a house, it's like you're spending, it's going to be consuming of a lot of your life, and you want to spend that with people that, you know, are aligned and are positive.
Yeah, I know exactly what you mean, because there's definitely people I've met and you walk away and you're like, I would never take $1 from this person. You know what I mean? It's just like, if this is how it is and we haven't even done anything, then it's just, it's going to be quite a painful 5-7 years plus that our relationship will be for this deal. So
yeah, and it's the same way that I work with my employees. I don't treat people like, you know, they're so like, with my investors, I know what I'm giving them is very unique, and our track record's extremely strong, and there's a lot of liquidity in the market right now, and it has to work for both sides. Like I don't, you know, I can get capital somewhere else.
So what kind of mistakes do you see real estate investors make throughout your decades of experience?
Oh man, like what kind of real estate investors? Like
just like anything that you've seen. I imagine you turn down a ton of deals. People partner with you. People want, like, just in general, it could be in any kind of asset class, over anything that you've done in your career. Like what's something you might see that comes up, you know, a couple points. It could be anything specifically.
Yeah. I mean, I made a lot of those mistakes in the very beginning when I just didn't know what I was doing. I mean, I think, you know, I kind of learned the school of hard knocks, but I think like underlying, people do tend to get excited about real estate and projects and neighborhoods and things. And I think that it's really like to be a steadfast investor and make strong returns over a long period of time, and not just get lucky by compressing cap rates or Nashville being a super hot market the last 5 years. That you have to be really diligent in looking at data. And we always talk about being data driven, but I tend to be really unemotional in terms of the approach I take with looking at the information and trying to, I mean, you can spend a lot of time on a deal and you have to be able to walk away if the numbers just don't work, and so that's something we've become pretty utilitarian about. And I think I've seen people, I just get pitched things and I'm just like, this just doesn't make sense. And it just amazes me how far people get down the line, or, how much people are willing to pay for land. And I'm going, okay, you're paying that. All that's happened since, you're looking at a deal, all that's happened in the last 6 months or year is that construction costs have increased by 15 to 20%. But now the sellers want 20% more for your land. And you have to look at that and really go, okay, can this market, it's not like renters are just going to be like, okay, I'll just pay 20% more now because we have so much less jobs with the pandemic. It just doesn't make sense. You have to really look at the numbers. And so when we do a deal, we're looking at a lot of the demographics that are surrounding it and not just doing what we've done because we've done it, And so I think not being data driven enough is a common mistake. I think, I think it goes towards different, if you're looking at it from the investor side or you're looking at it from the sponsor side. But I think, partnering with the wrong people, don't partner with friends. So that's fine. I think, gosh, there's been a few, but I think just doing the wrong deal, getting in at the wrong basis is always just a basic. And one thing I see younger sponsors or younger developers make the mistake of is, and I've made this mistake too, is paying too much for debt. And, there's a lot of these, especially if you're just starting out, you're trying to flip a home or something like that. It's like, it's easy to get into those situations where what do they call those lenders? Like shark lending or something like that. Like I see a lot of people kind of get into loans, and then once you're in it, you're really screwed until you can get out of it. So that's a big, watching carry costs and not project managing to manage that is a big problem.
Yeah, walking away is one thing you said earlier is much more difficult than it sounds, because after the more time you involve in a deal, it's just one of those things emotionally that you have to be able to have that discipline to cut and walk and go to your next deal. So, but
my solution for that is we have a very strong pipeline and we do usually around 10 deals at once. And so, if you have I think that's where people make the mistake is they only do one deal at a time and they get fixated on that. And then so that's how we kind of mitigate. We have a lot going on at once.
So as we're finishing up here, Meg, what do you think are the main factors that have contributed to your success over the years?
I get asked this and I think it changes, but I think generally, I've always done a lot of outreach. I still cold call people for, I'm raising a fund, my second fund now. And I think that skill set is wasted a lot in the next generation. And you talk and, I listened to a great podcast called How I Built This with Guy Raz. All those entrepreneurs, all of them cold called or reached a lot of people that are very successful have done door-to-door sales or something that requires a lot of outreach and a lot of, it's scary, but you kind of get over that hurdle of getting out there and putting yourself out there. So I think that's definitely been, I've done a lot of outreach and gone to conferences and things like that. So that's always, I think, key to being successful in whatever you're doing is just being willing to, constantly network and put yourself out there. And then I think perseverance is a big one. I mean, I always tell a story of one of my very first deals to my team when anyone, we do our retreats and when anyone starts, but this deal was totally screwed. It was my first deal. And I learned all those bad lessons on that deal. And we literally just sold it for, I think it was a 45% IRR and a great equity multiple. Wow. Total home run. We sold it for way more than anyone thought. So that took, 5 years of just perseverance. And you can walk away if it's a bad deal, but I was already had my money in, so I had to figure it out. So I think persevering is something that is a common theme of what I say, which seems generic, but it just, whatever you're doing, really having the gut to push through and really get something done. And then I'm very active. I do a lot in one day. I think a lot of people underutilize themselves in terms of what you can accomplish in a day. And, I wake up very early. I set a lot of goals for myself. At the beginning of the year, I set all my goals, and I fill my day with productive activity that works towards those, whether it's, my work or my husband or my philanthropic efforts or whatever you care about. I think, I don't know, I don't watch television. I read a lot. I don't spend a lot of time being unproductive. And I think that makes me really happy and is definitely contributing to the success of the company.
Awesome. So how can our listeners learn more about you and your business, Meg?
So we try to keep everyone pretty updated on LinkedIn and Instagram. So CA South Development's the Instagram handle, but it also goes through the CA South LinkedIn and also my page, Meg Epstein. So we try to, keep people pretty abreast of what we're doing that way.
Okay. Well, thank you so much for coming on. I'll put those links into our show notes and looking forward to connecting with you in the near future.
Thank you very much.
Bye-bye. Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.